Hey everybody, welcome back. Well, when we start to look at the market in and of itself, you really kind of pulled back a little bit. You didn't really pull back that much, and you're seeing a lot of exhaustion just on this pullback. And I mean, this is really how bottoms are formed. I don't know if this is a bottom, and I think we should just get that out of the way. If anyone just tells you automatically they know that this is not the bottom and they know the market's going to fall apart tomorrow, and just run away screaming, because frankly, nobody has a clue. If we clean all this off and we took a look from this bounce to here, and we just did the simple things to look at what we're dealing with, just from this little level to here, and then we went and looked at it and said, all right, what are fibs telling us about those levels? And just looked at it and dropped a line there, and you're like, okay, well, that's a 50% line. And that's not a fib level, but that's not the end of the world that you hit a level here and all you did was retrace 50%. And then out of that 50%, you're still net buyers of that bottom, going into everything that we went into today between the Trump conference call, and hopefully it looks like we're going to get some kind of limited ceasefire. At least they're shooting for that right now, which would be great if that can happen. I'm sure everybody wants that. So let's see how that goes. But you're wedged in here. Is this the end of the world? I really didn't think it was. I mean, you had your 9:30 drop. And then after 15 minutes, we went nowhere. We literally did nothing for the day. You're going to an FOMC tomorrow. I don't really view this as that bad of a move. So I guess my concern is that expectations in the market, when I look at how people are acting to this, I'm somewhat surprised that people are acting like it's the end of the world here again. Just because we rolled back over and backfilled a little bit. And this is actually healthy. Stocks going sideways and not just being short squeezed is actually really, really healthy. So really what you want to do is you want to watch when, because usually you retest these bottoms, you just want to see what happens when we get there and we retest. If we take a look at the NQ, let's just do it this way. I don't know why it always does this. I'm not going to have time to edit this. But if you look at the NQ, and say, okay, wow, that's a disaster. Well, duh. I mean, the market in and of itself doesn't look great, right? We already know this. We already know that this is the 100, the 22, the 55. We already know they're screaming down. Like, no one looks at this chart and says, this looks great. What you're trying to do is you're trying to find the first sign that you might start hitting a bottom. And the reason for that is because you're going to start seeing names that are going to start emerging as leaders. That's why you're looking for it. Not because you're going to do some kind of miraculous V. There's no V coming. There's nothing like that that's going to happen here. And I think there's a little delusion with that. You need to bottom, work through this, and go from there. And this takes weeks and months to develop. Our plan with the bottoming is that will show us where we should go. And I think it's pretty clear. I mean, I thought today was pretty clear on some things, and I'll show you a couple things out there that I thought were interesting. But to me, all I want to do is find out when that's going to bottom, because then you're going to have your peaks and your valleys, you're going to have your rallies, and then you can trade them. But until we have any of that, this gets a lot harder. So what I tend to do again is if we just look here, the bottom was hit on Monday, March 10th. Again, you would think that you fell off a cliff today, and then you mark these, and there's your 50% line, and you're on the wrong side of it. And you've been on the wrong side of it all day. So from my perspective, the semis look okay. But if we were to look at something like the ES, it looks a lot better. And XLF actually held fairly well today. But there's that 50% line, and there's that 38.2 line. It's not a coincidence that you're literally sitting between those two lines. And how did I get here? I took the low and the recent high of that swing. That's all I did. And when you look at that, this is why I like Fib, because all this is showing you is human behavior. That's all Fibonacci does, is human behavior. So you have these levels. I would do the same thing if you're out there looking at them and saying, oh, hey, what's really going on out there? What are the levels I need to watch? You do the same thing with the Qs. It's going to work exactly the same way. You might get some nuances because of how they trade, but roughly you can see that here. You're going to get that here versus the 10 here on the levels. But look what happens. Same exact area. I mean, it's the same exact area. So I always found that somewhat interesting. But take a look at the SPY, same exact thing. And really what we have here is we also have the smart money, dumb money correlation, to me, looking a lot better than people think it does. And then you're here and you're at that 61.8.5. So if you do something as simplistic as go, all right, well, show me XLF. Well, did XLF fall apart? So in other words, the market fell apart. XLF hit what? The 10th, which was roughly when we were here, right? That's when the ES hit it, and then the 13th was different. Okay, so we're going to take the XLF low, and we're going to come up here, and we'll see our levels. Now, they're a little inverse because the way I did it, but look at where you're at. You're at the low end. So again, if I did this the right way, because I know I threw everybody off, so I'll just do it this way. And you just drop this down to that level, what do you have here? You can't even break the 78.6 fib level. What's the panic? I guess is what I look at and go, what are people so afraid of? And then you look at something like the stocks and the same thing. Like, what really is going on out there? And so I think a lot of people are getting too trapped up in the noise, which is one of the reasons I always tell people to call their feed. You can't even do a 61.8% retracement. This is what you're dealing with right now. So to me, I think this looks great as far as hanging in there. Does it mean that it's all over and that we're just going to miraculously go up and it's go time again? No, you have to let this stuff build. This is when you can build huge positions and leave them on. Like, this is when you really want to start seeing where that new leadership is. But we'll get into that. But I want to show you a couple things. Let's get into smart money, dumb money, and then we'll go from there. Now, what we're looking for from this one little indicator is the following. And I'll show you a couple others that people use, and I'll tell you why I don't like them. But if you see right here, it's pretty obvious that when smart and dumb, they collide and you get a changing trend, you can see how that works. Now, this is very hard to use this past 3 years because the Fed was selling to us. They were selling trillions and trillions of dollars. So you didn't have just smart and dumb money. And this is why it's so important to know this stuff. You had dumb, smart, and itchy. And itchy was selling trillions of dollars to us, and they don't really register that in here. So it's kind of hard to stop or to look at this stuff when you have this. But as they got rid of all that Fed stuff, if you go look at the Fed balance sheet, as you would tie into this and like look at that on a time, as the Fed balance sheet started lessening, this became more relevant. And by the time you hit 23, we were pretty much done with just the dumping. And then we just had the sales. But if you take a look at how this is playing out, for example, right here, these turns were everything. And you can see again here. And why is that? Because that means that smart money is a turtle and they're holding, and dumb money is starting to catch up, even if it's slow. And you can see that here. You can hit, drop, come back down. But once you're up here, you're up here. And I don't think anybody can refute this. Now, the question for everybody is when you're up here and everyone's telling you the sky's falling, you kind of have to wonder what they're talking about, because smart money is buying the living heck out of this market on these dips, according to this chart. So if they're buying the heck out of the market and everybody's so panicked, what are they panicked about? This is where it really helps to become a critical thinker and turn off things. I used to say this all the time the first year I started doing this with YouTube. If you don't find something helpful, even these videos, if you don't find them helpful, call your feed on everything, YouTube, Twitter, everything that's throwing information at you. You can find a piece of information that's going to agree with every single bias that you have. You think the market's going down, you'll find a bias. You think your market's going up, you'll find your bias. What you want to look at is just as much empirical data as you possibly can, and then come up with a decision. The point that I'm making here is, if this, then this. That's it. This is not open to debate. You can debate it all you want. You're wrong because you're looking right at it. And so when you see this, and then you start to see something like this develop, does that mean that you're automatically going to what? You're just going to stop? No. You could go sideways. You could trade around for a while. But it does mean that most likely, worst case scenario, you're setting up for something like this, where you hit, make a lower low, and then that's it. That's worst case. That's my opinion of it. Doesn't mean I'm right, but if I'm going to interpret this, that's what it looks like. Look at this on a year. So if you just played this out over 12 months and said, I only buy the S&P after this turns, after it's up over the zero line, and that was your whole strategy. So after this is over the zero line and it turns, then I'm a buyer. So over the zero and it turns. And when you start to see them, you see this, you cannot unsee it. That's the point that I'm making. It doesn't mean you're going up forever, but it does mean that there's a turn there and you might want to be paying attention to it. Now, I just want to do a quick update. We did this earlier in the week, and I believe on Saturday. It's why I always state you want to subscribe to this channel, because everything follows through. We follow it through during the week. This is worth updating on. So for those that are newer and the first time here, welcome. We've been getting a lot of people lately that are newer, so I'm going to cover some of this stuff again. We do not refer to this as smart or dumb money. We refer to this as retail and institution. Why? Because smart money is calculated by institutional trading flow. Dumb money is calculated by retail trading flow. Think ETFs versus large lots of futures, to kind of put it into perspective. But we have smart, and that is divided by dumb, or institutional, that is divided by retail. And this just tells us exactly what's going on. What we'll note here is not rocket science, but it's worth pointing out, is that you have these levels of extreme, and they have them marked off as a +2.5 or a -2.5. And you can just see the lines right here. And of course, you can see the zero where you're neutraled out. And like always, nothing is ever really neutral, is it? So then if we can see out what's happening here, it's pretty obvious. When you're under this line, you're just kind of like grooving along. Things are good. But when you start to see that merge and start lifting higher, that's when you start running into a problem. Quick reminder that 27.5% of you still do not subscribe to this channel, even though you watch it. This might be a great time for you to hit that like button and click subscribe. Remember, these videos, they're all linked together. If you follow one, you follow the next, and they all come out at different times. Why? Because I'm not a YouTuber. I actually trade. So when you see this, look at this hourly chart. I want to point this out because this is really important. When you are trading these pullbacks and you have these corrections, and this is a correction, we can all see it. We can all see this. You probably don't even need me to do this, but there it is for you. And you see those levels. Everyone's going to tell you the same thing. Oh, you have to wait for the retest. You have to wait for this to happen. If you wait for that, you could be stepping in the false positive. What I tend to do with these, and what works very well for me, are these divergences. So if you see this divergence here, how you're taking out a low, and this RSI is not taking out a low, all this is telling me is magnitude of the move. Now, there's a lot of people that look at this very differently. There are people that look at this and they use RSI as a valuation metric, and they use it as a relative valuation metric, which is actually pretty interesting to think about doing it that way. So basically, if you think about it from a valuation standpoint, what they're actually saying, and it's not how I look at it, I look at it differently, but I understand why they use it that way. It makes sense. But if you think about it from that perspective, this is the value of the stock at this time, and then the value is here. So what they're saying is the value is the same price, but the valuation model is telling you that it should be higher. And that's how they wrap their noodle around it. But I get it, and I'm not knocking it. It's not how I look at it. Point being, once this happens, this is telling you when you pop, you want to be looking at this. A lot of people are using what I refer to as like pullback techniques to determine whether or not they're going to get into these. So pullbacks are very different than corrections. So when your market is in free fall, remember this, just so you can remember how I look at the world. Everything I do is top down. So I look at it and go index, then I go sector, and then I go stock. So the most important thing for me is to look at the indexes and what they're doing. So if the indexes in and of themselves, and I click through them, and I see something like that, I don't need the RSI right now, and I see this testing, and I looked in the hourly, and then I jump, well, it's on. Now I know that the hourly's here. To me, it's overbought, oversold, pulls back, and then we just lift, and we had 2-3 great days here of just playing around with the market, and it was a lot of fun. It was pretty easy trading, I mean, from Thursday and Friday on, right? I don't think anybody had a real problem with it. The problem obviously came in today with just the follow through and just the selling. And you can see we popped right over this level, and you can kind of go from there. The point that I'm getting at is when you're in an environment like this, a lot of people tend to use this, and they'll go, oh, I'm going to watch the 5-day moving average. Now, what I do is I use I have a 3, a 5, and an 8 on this chart. You should use whatever you're comfortable with. And I look at this on a 15-minute chart. You can look at it on any one you want. But if you're buying based upon the fact that, oh, I'm over the 5, or, oh, I'm going to buy because now the 5's pointing up, you're buying here, and you're walking into this suck salad in the morning. And the reason for that is because the same tools that worked in an environment back here, it's not the same environment. Your environment's completely changed. And if you don't understand that, this is when people run into problems, because they're using the same tools they used before for the same kind of trading. It's not going to work. And so you have to start thinking in terms of not only that, but you also have to think in terms of relative performance. So I would be looking at things that have oscillators that will give you signals that they're oversold, overbought, and I'd be using things that actually determine that you have a divergence, because they do work in this environment. Unless you're day trading, zero dated options, then it's just it's a coin toss, right? And all you're trying to do is do better than the coin toss. I mean, I get it. But if you're looking at something like that, pay attention to it. Now, you want to watch how you respond to support levels, especially previous support levels where you had RSIs that gave you positive divergences. You definitely want to pay attention. I'm going to give you a great example. All the hoople heads are going, oh, we're over the 5 and we retested. We're going to get in as soon as it flips. Oh, it flipped. We're in. Great. And now you're in at like 250, 251, whatever. And because you're above the 5, it retested and then made the higher high. Okay. Now what? Now you have this suck salad, right? Now it's at like 230. What are you doing? Well, you can't buy it because of the 5, right? No, wrong. What you do and what you're looking for is this kind of stuff and going, all right, so let me get this straight. We're washed out here. We come in the next day, we hit this level here. We come in, we hit it again here. So what do you have happening? We're hitting positive divergences on Tesla. What happens to Tesla today at that level when you look and mark it off? Oh, that same level where we had all those positive divergences, that held. So what people can do, and what a lot of people do in the community, is they use those levels and they just watch them. Now, whether it's that one or they use the one on the day, which is actually a lot cleaner, there's your daily level. All you're doing is hitting support. You're either going to flip or you're not going to flip. And then that's up to you if you want to use your 9 EMA on it or if you want to use your VWAP on the day. But when you're in this kind of environment, the money's made when you're overbought and oversold. It's not made in these environments where, oh, we're going to break out and run. You had all that institutional money cycle out. They're not going to be in a huge hurry to get involved. And so we have to understand that. The other thing is you already got overbought really quickly. So now we have to understand that we have to work that off again to some extent. And does that mean another retest of the lows? You have FOMC tomorrow, and we're going to have to go from there and see what, how that plays out. So you might want to watch that part of the video again. Some of these names, what I would say is that you're just stepping on time bombs. And so you're going to have to be really nimble here. So everybody likes spot. Everyone's going to tell you that they bought spot yesterday and that they made $40, but then no one's going to remember it or post about it today when it's down $30. And these are the kinds of time bombs that you're getting. I have a couple of these China names on. I will say this. If I watch this stuff at the end of the day and I watch like FXI, a little bit of selling, not a lot, but watch this KWeb at the end of the day. You saw a lot of selling in this thing towards the end of the day, and I'm not really sure that I'm crazy about this when I saw it. When I really started paying attention to this. So it's definitely something that's on my radar. When I was looking at this, like, oh, okay, so I get this drop, and then I see this little sell at the end of the day. We didn't have that on the Qs today. So if I go to the Qs, I was talking about this. This is, guys have already heard this if you were in the community. If you're not, there's a wait list, and I will be sending out some invites tonight, so just look for them if you are on that list. All right, so if you come here and you look at the 18th today, and you go, oh, okay, well, that's interesting. Let's just get to that level so that you can see. Boop. All right, that's interesting. So KWeb's down more than the NASDAQ. All right, look at the end of the day here, around that 350 level. That's when you get the market on close orders from institution. You had tons of selling. Now you had that close and push like right at the end, like the last minute, but that is what it is. At the end of the day, you actually were buying more of the NASDAQ than you were KWeb. And then you come and take a look at these over time. It's pretty clear that KWeb is just killing, absolutely killing the NASDAQ. I mean, one of the biggest institutional trades right now is long KWeb, and then you short the NASDAQ. I'm not so sure that you want to be, and this is from someone that, I do own some China names now, but I'm not so sure you want to be going hog wild with that pair trade or thinking that you want to be overweighted here. I don't think people are getting this yet, and I think that we might see a different kind of move in FOMC. A lot of this, guys, really depends on how he handles the call tomorrow. I think that's really important. One thing that did, in my opinion, went very, very poorly today for tech, and I think if this was not the case, I think we could have had a better day. This conference was a dumpster fire. I don't know if you watched it, but it was really just about how great NVIDIA is more than anything else, and it really wasn't a lot about this the new things with quantum computing. It was just all the stuff they're doing on AI. That's really all it was. Now, did you really break down? Not really. I mean, you kind of held your level right here, and you can see this, but did you really break down? Not really. Did you hold your lows? Yeah. I mean, it's better to stick in the eye, but it wasn't great. And I couldn't figure out for the life of me, 123, why this thing yesterday, where I got out some pre-market, I couldn't figure out for the life of me why it was dropping. And clearly this leaked. It's very clear that this leaked. And they knew that this thing was going to be a dumpster fire. So, or somebody got a copy of the report and realized that it wasn't going to have anything to do with the actual topic of the conference. And if you disagree with that, I mean, clearly the stock spoke, and you can see what people did with it from the moment that he started, which was right here, to what happened to the end of the day. It's very clear how that keynote was received. So that's pretty much it. We have to see what happens with FOMC and go from there.